The internal log was time-stamped 22:47 Eastern Time on a Saturday night in late March. Most JP Morgan employees were home. The quant desk was empty except for one junior analyst who had stayed late to rerun a volatility model that kept throwing errors. What he saw on the screen made him call his supervisor, who called the head of quantitative strategies, who arrived at the office in a cab still wearing a dinner jacket. The anomaly was not a massive trade that drained liquidity. It was not a flash crash or a regulatory breach. It was a single retail account flagged by the firm's own monitoring system. The bot attached to that account had executed a net of exactly one trade every 7 to 12 days for the past 8 months, maintained a win rate of 37%, and had returned a compound growth of 64% annualized over that period. The system had flagged it because it should not exist. The head of quantitative strategies, a man who had spent 18 years building some of the most complex financial models on the street, stared at the summary for 10 minutes without speaking. Then he said something the junior analyst would never forget. He said, "Run it again. Maybe the data is corrupt." The data was not corrupt. The bot was real. And nobody at JP Morgan could explain how it worked. That moment of institutional surrender is where this story begins. Not with the bot, not with the builder, but with the silence in a room full of the smartest quants in the world, looking at a number that violated everything they believed about how markets work, because that silence is the crack in the wall, and through that crack, the light comes in. The bot that broke their model did not use machine learning. It did not scan news headlines, scrape social media sentiment, or execute in milliseconds. It had no neural network, no reinforcement learning, no genetic algorithm optimizing 1,000 variables through the night. The bot was 2,300 lines of Python, most of them comments, and it had exactly one rule. Here is the rule. If the bid-ask spread on the asset widens beyond 1.2% during any hour of the trading day, enter a position at market. If the spread contracts back to the 10-minute moving average, exit. If the spread has not contracted within 48 hours, exit at a flat loss and do not re-enter for 72 hours. That is the entire strategy. There is no stop-loss optimization, no volatility weighting, no correlation matrix filtering out false signals. The bot does not care about the direction of the asset. It does not predict price movements. It does not ask whether Bitcoin will go up or down. It asks only whether the bid-ask spread has crossed a threshold that its builder determined, after 18 months of backtesting on historical data, was the exact moment when most institutional models go blind. This is the paradox the quants could not resolve. The bot was primitive by every metric they used to evaluate performance. It had no intelligence. It had no prediction. It had no speed. And yet in the specific conditions where their billion-dollar models were losing money, this bot was winning. Not by much, not often, but consistently enough that over 8 months the compounding effect made the numbers undeniable. The junior analyst who first spotted the flag later told a colleague that he had spent the entire weekend trying to reverse engineer what the bot was doing. He ran the strategy through 12 different market regimes, stressed every variable, tested it against every crash and liquidity crisis in the historical record. The bot survived all of them, not because it was robust, because it never traded in the conditions that killed other strategies. If you have ever sat through a drawdown where every signal told you to hold and every instinct told you to cut, and you did not know which voice to trust, you have felt what the quants felt when they looked at that bot log. You have experienced the cold recognition that someone else sees the market differently, that they have built something that does not try to be right. It only tries to avoid being wrong. And the difference between those two things is the difference between surrender and survival. That moment when you realize the most dangerous thing in the market isn't a supercomputer. It's a truck driver with a pawn shop laptop and a single idea. If you want to see exactly how he built a strategy that survives when everything else fails, subscribe, because what comes next is the kind of edge the quants will never publish. And while you're here, drop the word primitive in the comments if you've ever watched a simple setup outperform your fanciest indicator. The head of quantitative strategies asked for the builder's identity. It took the legal team 3 days to find him. He was not in New York, London, Hong Kong, or Singapore. He was not a former Goldman trader or a Citadel refugee. He was a former truck driver living in a town of 800 people in the middle of the Nebraska sandhills who had taught himself to code using a single textbook and a $400 laptop from a pawn shop. His name was not important to the investigation. What was important was that he had never worked in finance. He had never taken a course in econometrics, stochastic, calculus, or market microstructure. He had never even seen a Bloomberg terminal. He had built his bot in a rented room above a tire repair shop, using data from a free API limited to 1,000 requests per hour, running backtests on a desktop computer that took 3 days to simulate a single year of historical data. The quants demanded to know why he had chosen that specific spread threshold. The answer came back in a single sentence, preserved in the internal notes of the investigation. He wrote, because at 1.2%, the market is in pain. And when the market is in pain, it moves in ways the models cannot predict. So I do not try to predict. I just show up and wait. That sentence became a kind of legend inside the firm. It was quoted in meetings, posted on the internal Slack, used as a case study in a training deck for new analysts, because it contained something that the models could not generate, something that the training data could not extract, something that no algorithm had ever been taught. It contained a theory of the market that was not mathematical. It was anthropological. The builder understood that the bid-ask spread is not a technical indicator. It is a social signal. It is the market telling you that participants have stopped trusting each other. When the spread widens, it means that the people who normally provide liquidity have withdrawn. It means that the algorithms that usually match buyers and sellers have disabled themselves because their risk parameters have been violated. It means that the machine of the market has stalled. At that moment, most institutional models go into a protective crouch. They reduce position sizes. They widen their own filters. They wait for the conditions to normalize so they can resume doing what they do. But the builder's bot did not wait for normalization. The builder's bot interpreted the widening spread as the only signal that mattered. Because amid the chaos, one thing remains true. When everyone else is running for the exits, the person who walks slowly to the door does not get trampled. The quants spent months trying to replicate the bot's performance. They built versions with machine learning, with neural networks, with ensemble methods that combined a dozen models into one. None of them achieved the same results because they were all trying to optimize. They were all trying to be better. They were all trying to predict. And the original bot did none of those things. Let me say that again because it is the core of the whole story. The bot did not try to be better. It did not try to beat the market. It did not try to outsmart the quants. It tried to survive a condition that it had identified as the one moment when the rules of the game changed. And in that moment, it did not act like a trader. It acted like a threshold, a door that opens only when the pressure is high enough, a gate that closes only when the flow has returned to normal. No judgment, no hesitation, no hope that the trade will work out. The bot had no opinion about the trade. It had an opinion about the condition. And that distinction, which seems subtle, is the entire difference between the institutional mindset and the underdog's edge. The quants thought in terms of predictions. The builder thought in terms of states. The quants asked, what will happen next? The builder asked, what is true right now? The quants tried to know the future. The builder tried to recognize the present. And in a market where the future is fundamentally unknowable, the person who can recognize the present has a structural advantage that no amount of computing power can overcome. Here's where the story gets stranger. The builder did not know about the J.P. Morgan investigation until a lawyer from the firm called him 6 weeks after the flag was raised. The call lasted 12 minutes. The lawyer asked him to explain the logic of the bot. He did. The lawyer asked if he would be willing to license the strategy. He said no. The lawyer asked if he would consider selling the code. He said no again. The lawyer asked why, and the builder gave an answer that would circulate through the firm for years. He said, because if you have my code, you will change it. You will add optimization. You will add variables. You will try to make it better, and then it will not work anymore. So I am going to keep it the way it is. And you can keep running your models, and we will see who is still here in 5 years. That answer is the quiet counterpoint to every optimization obsession in crypto. If you want to keep uncovering these inverse edges that the quants miss, subscribe, because this channel exists to show you the moves the crowd refuses to see. And I want to know, what is one variable in your own trading that you know you should strip away, but keep adding back? Drop it in the comments and let the rest of us see where the simplicity hides. That answer is the key to everything. The quants were trapped by their own competence. They could not stop themselves from improving. They could not stop themselves from adding complexity. They could not stop themselves from believing that more variables meant more truth. The builder, who had never been trained in any of this, understood something that their degrees and their experience and their awards had blinded them to. Sometimes the most sophisticated thing you can do is refuse to add another layer. Sometimes the smartest strategy is the one that you do not let yourself improve. Sometimes the edge is not in the code. It is in the discipline to leave the code alone. Now think about what that means for you. Think about every time you have added an indicator to your chart, added a filter to your bot, added a rule to your system, because you felt like you were not doing enough. Because you saw someone else with more variables, faster execution, bigger data, and you thought, I need to be more like them. I need to compete on their terms. What the builder understood, and what JP Morgan's best quants could not accept, is that competing on the institution's terms is a losing game. They have better data, they have faster infrastructure, they have more people, more capital, more computing power. If the game is a matter of who has the most sophisticated model, you lose. You always lose. That game has been rigged from the start. But the builder did not play that game. He played a different game. He found a single condition under which the institution's advantages became irrelevant, and he designed his bot to operate only in that condition. He did not try to beat the institution in the markets where the institution was strong. He waited for the markets where the institution was weak, and then he traded. The quants called it luck. They called it a statistical anomaly. They called it a random walk that happened to land in the right direction. They spent 6 months trying to disprove the bot before they finally admitted, in a confidential internal memo, that the bot's performance could not be explained by chance alone. The memo, which was later leaked to a regulatory publication, contained this line: "We have tested this strategy against historical data from every major liquidity crisis in the past decade. It survives all of them. We cannot model why it works at the theoretical level, but we cannot deny that it works at the empirical level. We recommend further research." That memo is the surrender document. When an institution admits that it cannot understand why something works, it has admitted that its framework for understanding markets is incomplete. And when your framework is incomplete, every decision you make from within that framework carries hidden risk. The quants did not only lose to the bot, they lost to the fact that they could not understand the bot. Let me tell you what the builder told the lawyer at the end of that 12-minute call. The lawyer, frustrated by the refusal to sell, asked one final question. He asked, "What do you want us to understand about this that we are not seeing?" And the builder said, "The market is not a puzzle to solve. It is a room full of people, and most of them have no idea what they are doing, including you. So when you find something that works, do not try to make it work better. Just keep doing it, because the market will change, and whatever you built to exploit the last market will break. But if you build something that does not try to exploit anything, it will survive anything." That was the moment when the head of quantitative strategies, sitting in his office at 10 o'clock on a Tuesday night, closed his laptop and did not open it again until the next morning. He did not tell anyone this, but a colleague noticed that the next day he moved a small piece of paper from his desk drawer to the corner of his monitor. The paper had 4 words handwritten on it: "Survive anything, exploit nothing." The bot is still running. The builder never sold it, never changed it, never added a single line of code. It still trades the same rule it traded 8 years ago. And every quarter, when the performance reports come out, the same junior analyst who flagged it that Saturday night checks the account balance. The number is still climbing, and the models at JP Morgan are still trying to figure out why. The builder lives in the same town. He drives the same truck. He rents the same room above the tire shop. He does not take meetings. He does not do interviews. He does not try to grow the bot, scale the strategy, or attract capital. He has found his threshold, and he respects it. The question that the quants could not answer, the question that this whole story has been circling, is not about the bot. The question is about the builder. Why did he stop? Why did he not try to make it better? Why did he leave the code alone? And the answer, when you finally hear it, is the most uncomfortable thing you will encounter in this entire narrative. He stopped because he knew that the moment he tried to make it better, he would lose the only thing that made it work: the discipline to do nothing, the discipline to wait, The discipline to accept that a 37% win rate is not a weakness. It is a recognition that the market is fundamentally uncertain and that trying to predict the unpredictable is a form of arrogance that the market will eventually punish. Everything that the quants were trained to do, everything that their degrees and their experience and their bonuses rewarded, was activity. More trades, more data, more analysis, more optimization. And the builder, who had no training, no degree, no bonus structure, understood that activity is not the same as effectiveness, that motion is not the same as progress, that doing something is not always better than doing nothing. If you have ever sat in front of a screen at 3 in the morning, watching a position go against you, feeling the urge to close it, to do something, to stop the bleeding, you know exactly what the quants felt when they looked at the bot log. You know the agony of inaction. You know the terror of doing nothing while the market moves. And you also know, because you have felt it, that sometimes the best trade is the one you do not make. The builder understood this at a level that the quants could not reach. Not because the quants were stupid. They were brilliant. They were among the smartest people in the world at what they did. But their brilliance was the thing that trapped them. They had too many tools, too many options, too many ways to intervene. And the builder had nothing but a rule and the discipline to follow it. That is the inversion. That is the thing that the institution could not accept. The underdog did not win because he was smarter. He won because he was simpler. He won because he had less to lose. He won because he had not been trained to see complexity as a virtue. He won because he did not know that he was supposed to be losing. The inversion is real, and you just saw it play out not in a hypothetical, but in the cold numbers of an actual institution. If that truth resonates with you, subscribe, because this channel exists to uncover the moves the machines don't want you to see, and the next story is already forming. Before you go, drop a comment with the word simplicity if you have ever chosen a single rule over 100 indicators, and tell us what happened when you did. There is a final detail that did not appear in any of the internal memos. It came from a conversation between the junior analyst and a friend who worked on the trading floor. The analyst said that when he ran the bot's strategy against the firm's own data, he noticed something strange. The bot was not only winning, it was winning in the exact conditions where the firm's most profitable strategies were losing. It was not competing with the institution. It was filling the gap that the institution had left open. The firm had built models to profit from every market condition except one, the condition where the spread widens beyond a certain threshold. They had assumed that condition was unprofitable. They had coded their models to avoid it. And in doing so, they had left a piece of the market on the table. The builder did not take that piece because he was aggressive. He took it because nobody else was there. That is the final lesson of the bot that broke JP Morgan. The market is not a zero-sum game where the winners are the fastest and the smartest. It is a landscape, and the most valuable territory is not the contested ground where everyone is fighting. It is the ground that everyone has abandoned because they assumed it was worthless. The builder found that ground. He sat on it, and he waited. The quants could not understand why they lost because they were asking the wrong question. They were asking, how did he beat us? They should have been asking, where are we not looking? The answer was a spread threshold of 1.2%, a number that had been hiding in plain sight in their own data the whole time, a number they never noticed because they were too busy looking for the next big thing. That is the uncomfortable truth that this story leaves you with. You do not need to be faster. You do not need to be smarter. You do not need more variables, more data, more computing power. You need to find the one condition where the models of the institution are blind, and you need to be willing to sit there and wait until the market comes to you. The bot has been running for 8 years. It has never been updated. It has never been optimized. It has never been improved, and it is still winning because the condition that the builder identified is not a market cycle. It is a permanent feature of how markets work. As long as there are institutions with complex models that flee from certain conditions, there will be room for the bot that stays. The builder did not beat JP Morgan. JP Morgan beat itself. They had the data. They had the talent. They had the resources. They missed one number in their own data because they were trained to see the market a certain way. And that single blind spot was enough to give someone else the edge. The question you have to ask yourself is not whether you can build a bot like this. The question is whether you have the discipline to leave it alone once it is built, whether you can resist the urge to optimize. whether you can sit through the months of flat returns, whether you can accept a win rate that looks like failure to everyone else, because that is the price of the edge that the institution cannot copy. It is not a technical price. It is a psychological price. It is the willingness to look like you are losing while you are actually winning. It is the willingness to be misunderstood. It is the willingness to be the person who does nothing while everyone around you is running. The junior analyst who flagged the bot that night never told anyone what he whispered to himself when he closed his laptop and walked out of the office. But his roommate heard it. He said, "I have been in the building for 3 years, and the most dangerous thing I have ever seen is a man who knows how to wait. The bot is still out there, still trading, still winning, still doing nothing that the models can understand. And the quants at JP Morgan, if they are being honest with themselves, still check the numbers, because deep down they know the question is not whether they will catch up. The question is whether the builder will ever stop. And if they have learned anything from the data, it is that he will not."